Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I am your host, Neil Gibb, and today I want to talk to you about the power of compounding. The power of time in the market compared to timing the market. And I want to break this down in a real simple way that's easy for you to follow, because compounding is the force that decides whether your money grows for you or grows against you. It's been said that compound interest is the eighth wonder of the world, and those that understand it benefit from it, and those that don't pay for it. And it starts off pretty slow. It can start off pretty boring. It almost feels invisible. And then before you know it, you look around, you'll be like, holy moly, I'm so glad I took the plunge when I did, because it's starting to pay off. Now, if you're an avid investor, if you listen to this podcast, there's a good chance that you've heard of a guy called Warren Buffett, one of the richest men on the planet, and is also sat on the sidelines now with billions of dollars in cash ready to invest. But he also says that his reason that he's the wealthiest man on the planet, or one of them, is not luck, not timing, but time and consistency. Let me kind of break that down on what that looks like, right? So time and consistency in the same deal. If I could give you $1 million today, or I could give you a cent that doubles in value every day for 30 days, which one would you take? 1 cent versus $1 million. A lot of people would take the $1 million, right? Give me the mill right now, Neil. Give me it, because a cent that doubles in value every day for 30 days probably does not sound that exciting, right? But here's how it actually works, right? Day 1, it's 1 cent. Day 2, it's 2 cents. Day 3, it's 4 cents. Day 4, it's 8 cents. And day 5, it's 16 cents. Now, I'm not going to bore you and go through every single day, but at day 5, we're at 16 cents, right? At day 10, it's worth $5.12. You're probably thinking, give me the $1 million any day of the week, twice on a Sunday. By day 15, your $5.12 is worth $163.84. And you're probably thinking, yeah, Neil, give me the mill. By day 20, it's $5,242. You're probably still thinking, Neil, give me the mill. Day 5, it's $167,772. And you're like, yeah, the mill was the winner all day long. But here's where compound interest starts to really outperform everything else. Day 26, $335,000. Day 27, $671,000. Day 28, $1.342 million. Day 29, $2.6 million. And day 30, $5.3 million. That 1 cent decision then becomes more than $5 million. This is, Warren Buffett says that 97% of his wealth came after his 65th birthday because of compound interest. And if I can give you a kind of clear image in your mind of how this actually works, right? Let's picture a snowball at the top of a hill. This tiny little snowball that you've made with your hands, right? And you stand there at the top of this hill and you just nudge the snowball and it starts to roll. And it starts to pick up more snow. With every turn, it gets a little bit bigger, a little bit bigger, and a little bit bigger, and a little bit bigger, and a little bit bigger. Then before long, this snowball is the size of a car. And with every turn, it's getting bigger. It becomes the size of a house. And then it's the size of an avalanche. Not the size of an avalanche, it becomes an avalanche. And this is compound interest, right? This is Warren Buffett's journey. He started off with a snowball that got bigger and bigger and bigger. And now his wealth compounds so much on an annual basis, he literally cannot invest it fast enough. It's compounding. It's boring at the start. It can be slow at the start. It can be almost invisible at the start, but it's powerful at the end, right? Time in the market is better than timing the market. And property follows the exact same pattern as the snowball. So it typically compounds through three forces that all work at the same time if you invest in the right style of asset. So you've got equity that grows as your value rises in property. Property rises in value, sorry. You obviously get your rents going up in value so that your cash flow increases. And you also, if you've got a principal and interest mortgage, your debt is falling so that your wealth is increasing twice as fast as everybody else. Each tiny little force feels small by itself, but together over time, they behave like the snowball, slow, then fast, and then life-changing. And if you think about how this actually works, right, and how fast compounding can work, right? Let's just say you buy a $1 million property and you can control that $1 million property by putting $100,000 down as a 10% deposit. Now, you might have the borrowing capacity of this, you might not, but let's just hear me out for this story, right? You've got $1 million asset and you put $100,000 down on that property. Your $1 million asset has gone up by 10%, right? And you're thinking, fantastic, Neil, it's now worth $1.1 million. But when you look at the money that you've got in the deal, which is 100, investment hasn't gone up by 10%. Your investment has doubled in value because the $100,000 that you put in to control that $1 million property is now worth 1.1. You've made 100% cash on cash return. That's the power of compounding. Then if your property goes up another 10% again, you've made more money on that again. So your $100,000 has just gone up $110,000. You've made another 100% cash on cash return. It's actually 110% cash on cash return. And this is how it starts to really compound. Now imagine you've got 2, 3, 4, 5 properties all going up between 7, 8, 10, 15, 20% per annum. This is when life really starts to change. This is when the rubber starts to hit the road, and this is when you start to build serious wealth. And it's not about like how many can you do, and it's not about how fast can you do them. It's more about taking action, because compound interest doesn't actually care about where you are and when you do it. It just cares that you do it, right? And I always hear this, right? Like sometimes I run through like client success stories with people and show them the people that invested in 2020, 21, 2020, 2022, how they've made anywhere from like 120 to 300% in terms of the value of that property going up in value. But when you look at the return on investment on the cash in the deal, it's like 1,000%. It's incredible. And people are just blown away because like I've never looked at the numbers in this way before anyway. But then I hear people that are 40, 50, even some people in the 60s, and they say that they can't change their life because they think they've left it too late. But we've had people like some of our first clients were in their 60s when they came to work with us, and now they've got 4 properties and they've retired and they're living life and they're traveling around and they're enjoying life. Because like I said, compound interest doesn't care about your age, right? It just cares about the fact that you get involved, take action and get into the market. Like Warren Buffett, like I said, he didn't become a billionaire until he was in his 60s, but the snowball had been rolling down that hill for decades and decades and decades, and the properties or the business that he's invested in got bigger and bigger and bigger. That's how he became incredibly wealthy, by delayed gratification. Like, and if you know anything about Warren, he's probably the tightest man on the planet, even though he's one of the richest. He still eats at McDonald's. He still drives a crappy little car. He still lives in a very average house, considering like the levels of wealth that he's created. And each to their own, right? That's not for me. I like to actually enjoy some of the fruits of my labour: holidays, cars, houses, that sort of stuff. But there's also a opposite side of the compound interest phenomenon, and that is debt, because debt also compounds the same as money. So imagine you've got a $5,000 credit card. Like you've got your $5,000 limit, you've maxed it out, and you're just like, I'm just going to pay the minimum monthly payment on that card. And it's got 20% interest per annum. And 20% per annum is roughly 1.6% per month. Month 1, your interest is $83 and your minimum repayment is $100. So out of your $100 repayment, if $83 is going to interest, then only $16 pays off the actual debt. So your new balance is $4,983. Pretty average, right? Because you are paying off such a high interest component on that credit card, it would actually take you 20 to 30 years to clear the $5,000 balance off that credit card. And you'd be paying $8,000 to $10,000 in interest for a $5,000 credit card, paying it off for 20 to 30 years. That's how compounding can work on the opposite side of the spectrum. That's the snowball rolling up the hill, essentially, right, instead of down the hill. And it can also work with your home loan. It can also work with your investment loans as well, because mortgages and banks in general, they love to, the reason that banks are so profitable, right, is they, don't get me started on the banks, but they lend out money that isn't even theirs, and they charge interest on that money. And then, that's how they make billions and billions of dollars of profit every single year. So if we let's take a $500,000 home loan at a 6% interest rate, right? The bank want you to pay your minimum repayments for the next 30 years. Because if you do, you are going to be paying hundreds and thousands of dollars in interest payments to that bank. If you've got a $500,000 loan, you're probably going to be paying $300,000 to $400,000 in interest payments to that bank. They essentially double the money over that time period. It's a great cash flow model as well, right? Because every month they're getting cash flow from you. But if you look at your principal place of residence mortgage, right, and you pay an extra $200 a month on a $500,000 home loan, it can reduce your home loan, your 30-year loan, by 5 to 7 years. If you pay an extra $500 a month, you can shave off 10 years off your home loan. Why? Because every single extra dollar you pay above your minimum payments actually reduces the principal. And when the principal drops, the interest charge drops the next month as well, because interest is calculated daily on your mortgage. So every time you pay off the principal, the interest, the interest that they pay on the outstanding balance is calculated daily. If you can pay fractions off this on a daily basis, you'd be even better again. But who gets paid daily, right? We get paid weekly. Every extra single payment that you make speeds up the compounding effect, right? And this is why debt reduction is one of the key parts that we focus on with our clients, especially if they've got a certain goal to hit within 10, 15, 20 years. Sometimes you don't need 5, 10, 15 properties to achieve financial freedom for you. Everyone's version of financial freedom is totally different. And sometimes it can just be one property that you just sit at principal and interest, and also use the additional cash flow to pay down the debt on that property so that it's debt free in 10, 12, 15 years. And when you're paying the debt off an investment property that fast as well, or your principal place of residence, you can save 15 years worth of payments to the bank, and you can save hundreds of thousands of dollars as well. And what could you do with an extra couple of $100,000? Buy another property, go on more holidays, enjoy your life. There's so much you can do when you've got this sort of time and freedom, because you're not tied into a big mortgage. So let's look at two people, right? Side by side, both got the same jobs, the same income, the same outgoings, they live in a very similar house. One sits on the fence, gets splinters in his bum, reads the news, waits for the perfect timing, never takes action because he believes that it's always the wrong time. The market's moved too much. It can't keep going the way it is. All the other stuff that I hear on a daily basis, right? Doesn't take action. Sits there, procrastinates, loves looking at his money in the bank. The other one takes action, and all they do is they buy one solid investment. 5 years later, number one hasn't done anything, hasn't moved, and is still in the exact same position. Number two, they've had 5 years worth of capital growth, 5 years worth of rental income, 5 years of paying down debt, and 5 years of increasing their net worth. And when we think back to Warren Buffett, it's not about skill, it's about action. Now, don't get me wrong, I'm not saying Warren Buffett isn't skillful and isn't knowledgeable, but he took action in the early days, and that's what the difference is, right? This is like flicking the snowball off the top of the mountain, just getting that momentum going, getting your money working harder for you because you don't want to keep working hard for your money. And right now in Australia, this is literally the best country in the world. I know there's a lot of people moving to Dubai right now. I believe Australia is the best country in the world. It might be a little bit biased because I live here and I absolutely love it. But the one thing that tells me that this is such a great country is the population growth. People are coming to this country en masse because it's in a beautiful place to live. It's an incredible place to live. But the problem with that is it creates a very tight housing market, almost creating not just unaffordable housing, but what's the word I'm looking for? It creates a problem in the housing market because we just don't have enough supply, right? More and more people move to the country. We've got a really, really restricted supply into the housing pipeline because we can't get materials fast enough. We can't build fast enough. We don't have enough people. And this in turn increases property prices, rises rents, and also creates so much demand that like properties are just going up in value constantly. These conditions give compounding a tailwind. It's like things are just moving faster than ever before right now. And Australia is fastly becoming one of the most unaffordable places to live in the world, but it's still the most beautiful. And that's why more and more people keep coming here, right? So compounding can, it tests your patience, right? People will quit early. People will sell properties early. People will want to see results faster than what they actually get them. And they'll want to see 5 years worth of results in 1 year, right? And Tony Robbins says people will overestimate what they can do in 1 year, but underestimate what they can do in 10. And that's the same with property. Like, you would not believe how many people want to achieve like the glitz and the glamour and the unicorn in that first year. But then you show them a cash flow model that says you can produce $110,000, $120,000, $130,000 a year with one property, but it's going to take you 10 to 15 years. It's not that exciting for them, right? Because everybody wants to get the results now because of instant gratification rather than delayed gratification. Well, if we think back to the penny that doubles in value, or the cent that doubles in value every day, it just shows you the power of compound interest. All the power sits towards the end of the journey, not the start. Like the snowball itself starts off small, but it needs time to grow. That's why I confuse snow with grow. It starts off slow. It starts off boring. Over time, it will get better and better and better. One property grows in value, and then you can refinance and move into property number 2. Then you've got 2 properties which are going up in value. And when they go up in value, then you can refinance and you can buy number 3 and number 4. And then you can get to a point where you can make more money in 12 months through your property going up in value and through the cash flow that your property generates than you could do by working 40 hours a week, 52 weeks of the year, or however many you work in a job that you might not like. And you might want to do something else with your life, but you might just be doing that job because it's good enough to pay the bills, right? What if your property portfolio could do the heavy lifting for you? What if it goes up in value more than your PAYG income does, but also produces enough cash flow so that you don't need to work in a job that you might not like? Now, you've got to think about, what does that look like? How do I know what's the right investment? First of all, you need to know where you're going to, right? What do I want from my life so that I know the steps to take towards it? And again, Tony Robbins says, once you know what you want and why you want it, then how to get there is a little bit different, right? But if you don't know where you're going to go, then you're just like a ship sailing in the ocean without a sail. You're going to get dragged anywhere and everywhere that takes your attention. But if you set goals and you stick to your goals, when you get pulled off course, you can go, hang on, feel like I'm off track. You can go back to your goals, and then you can put yourself on the right direction again. This is why I'm very, very big on setting goals, reviewing goals, and adjusting goals if they need to be adjusted. But if they don't need to be adjusted, don't change them just because you're off track. Use them goals to pull you back on track. So first of all, know where you want to be. Secondly, work backwards, and then take small incremental steps every single day to get you towards them goals, right? These small steps, almost like the snowball. These small steps might be, I need to speak to my mortgage broker. I need to speak to someone about setting up an entity. I need to speak to some real estate agents. I need to learn how to do subdivisions. I need to learn how to do renovations. I need to learn how to track different markets so that I know what's going to work and what's not going to work. That's how you take advantage of compound. Compounding interest also works in terms of actions, right? But it also does not care about your age, your timings, or luck. It just cares that you start. It cares that you stay consistent, and it rewards the people who keep rolling the snowball forward. So if you're thinking about finishing this year, maybe you're thinking, you know what, I'm just going to park it now and I'm going to start next year. Maybe this is the episode that actually makes you think, you know what, I'm actually going to get started now. I'm going to keep the momentum going so that I can roll into 2026. And I've already spoke to my broker. I already know what to buy. And I can spend this quieter time in December looking for the properties that I need to buy to add to my portfolio to help me build wealth in 2026. Because if you think of them two people at the start of the journey, one does nothing for 5 years and one takes action, which one are you going to be? You're going to be the person that does nothing because you're too busy reading the media, too busy listening to the news and the doomsday headlines that tell you that the world's going to end. Or you're going to be the person that uses the macro and the micro data, which we spoke about in the last podcast, to make smart, educated decisions and build wealth in 2026 and beyond. Join us again next week on the HMO Property Show. I'm Neil Gibb, and I'll see you soon.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.